Hello, everyone. Welcome to Accounting Focus. My name is Richmond, and I'll be leading you in today's presentation. So, basically, what this channel is about has to do with focusing on standards and then solving past standard questions from ICA, ACC, and SEMA. So, what we do here is that after we give you the concept and the breakdown, we also solve past questions so that the understanding will be more practical. Okay. So, to focus on today's episode for the day, we are going to talk about IS system. So someone will ask, what is IS system? What is property, plant, and equipment? Okay. Now, property, plant, and equipment are long-term assets. Okay. Now, these long-term assets are significant items that are shown on the face of the financial statement. As a result, this IS system, property, plant, and equipment, gives us the guidelines or the basis on how to recognize these assets on the face of the financial statement and how to even measure it. Okay, so today's video is basically going to talk about all these things, so stay with me so that you appreciate IAS 16 at the end of the video. To begin with, IAS 16 is actually an old standard which was issued in 1982. Okay, we've made the amendment that followed. So, IAS 16, when you talk about standards is evolving, okay? So what happens is that as and when, the certain things change, IASB makes some amendments to suit the current conditions, okay? But the question is, what is the objective of this standard, IAS 16? Why did we issue this standard? So this standard was actually issued to help us account for PPEs, okay? So if it is issued to help us account for PPE, the question is, what issues does it address? So we are basically going to focus on two issues here. And these two issues, we are going to focus on what and then how much. So when you talk about what has to do with two things, that is the definition and then the recognition. So when you talk about the definition, so this is the definition and then the recognition. So when you talk about the definition, there are instances where some items appear to be PPEs, but they are not PPEs, okay? So this standard will help us understand which items falls under PPEs. Are you with me? And then when you talk of recognition is saying that at what point do we show this in the statement of financial position? Are you with me? So this standard will help you appreciate this concept very well. Now, when you talk about how much talks about the carrying amount and then the depreciation to charge. So when you talk about carrying amount basically has to do with after you measure the asset, what value should you show in your books? So year one, what value should you show in your books? And then when you go to year two, what value should you show to it? So this is the carrying amount. And then when you talk about depreciation to charge, the depreciation to charge, when you use an asset, depreciation. So when you use an asset, this asset undergoes depreciation. So how do you compute this depreciation? IAS 16 talk about all these things. So we are going to look at it in the later chapters, okay? Now, you realize that before I spoke about two issues, and these two issues has to do with what and then how much. So when you talk about what, the what basically focus on definition, is that not it? So the next thing we are going to talk about has to do with the definitions. Now you realize that I have highlighted some key things here in green. So held by an entity, production, up to the year. So now when you talk about PPEs, what are PPEs? PPEs are tangible items that are held by an entity for use in the production or supply of goods and services, for rental to others, or for administrative purposes, and are expected to be used for more than a year, more than one accounting year. Okay, so now this is giving us the definition on how to identify what a PPE is. So if first of all we are saying that they are tangible items, so there are items that you can actually hold, touch, and feel. Is that not it? That is what tangible means. Is that not it? Now, if this entity can hold the asset and they use the asset in the production or supply of goods and services. So let's say we have a manufacturing company and they have this particular item that they use in the production of goods and services. It means that that particular item can be classified as PPE. Okay. Now, for rental to others. Now, when you talk about the rental to others, you are not talking about buildings, okay? When you talk about buildings being used as rental to others, it's more under IAS 40, okay? But when you talk about this rental to others, you are basically focusing on the vehicles, and then other, machineries, okay, machineries and equipment. So that is what the focus should be on. So if you have these items that you can give it out for rent to other people to use, it can also be classified as PP. And then for administrative purposes, you have this office, you use, machines, you use laptops, you use desktop, and you use, air conditioning. All these are examples of, tangible items that are being used for administrative purposes. I hope you are getting it. And there is this key thing here. The key thing you are supposed to focus on has to do with they are expected to be used for more than 1 year. So if the assets cannot be used for more than 1 year, you cannot classify it as PPE. Are you with me? So that is the most important thing. So all these things goes with the fact that they are expected to be used for more than one accounting year. So that is the definition. And I hope it is clear. Now, when you talk about recognition of PPE as an asset, so now we've been able to understand what PPE is. We understand the definition. Now, the question is, at what point do we show PPE in our books? At what point do you show this PPE in your statement of financial position? Now, to show PPE in the statement of financial position, there must be two conditions that it satisfies. And what is the first thing? The first thing is that it must be probable that the future economic benefits associated with the asset will flow to the entity. So you realize that I've indicated in there rewards and risk. So in terms of probability, when you say probable, when you are giving this probable in terms of percentage, it means that more than 50% chance, okay? So if you are using an asset, and then, or if you are acquiring an asset, and then you know that this asset will give you some benefit, the chance that this asset will generate, revenue to the, the company, or there are certain benefits associated with the asset which will flow to the entity, it means that it is possible to recognize this asset as PPE. Okay. And I realize that I indicated rewards and risks. So when I talk about rewards has to do with, okay, it's helping you generate income. Okay. It's helping you, carry out your day-to-day operations. Those are the rewards. Now, when you talk about the risks, when you're using an asset, the assets has to be maintained, right? So you must incur maintenance costs. If it falls, you must repair it. All these things are the risks. So these rewards and risks associated with these assets must flow to you, the entity, of your getting it. And then the second condition has to do with the fact that the cost of the assets can be measured reliably. So if you are using an asset that you cannot give value to the asset, then the asset cannot be recognized as PP. But when these two conditions are being met, so the fact that it is highly probable, the chance that the future economic benefits associated with the assets in terms of rewards and risks will come to you, the entity, and the fact that you can also give the value, you can give value to the asset, that we say that you can show this asset as PP in your books. Okay. Now, in terms of the measurements, I mentioned it's being measured reliably, right? So in terms of this measurement, we have what we call initial cost and we have subsequent cost. So this initial cost and subsequent cost, what you have to know is that they must both satisfy the two conditions above, okay? They must go satisfy the two conditions above. Now, we've spoken about the measurement, we've spoken about the recognition. So you remember in the previous chapters that I told you that we are tackling two issues. And when you talk about the two issues has to do with what and how much, right? So the what talks about the definition and then the recognition, which we've spoken about. So in terms of the measurement, we're asking, what value should you show in the books? How much? In terms of the how much, what value should you show in the books? So I mentioned that we have the carrying amount and we have depreciation to charge. But in terms of the value to show in your books, there are two methods. And these two methods are, one, initial measurement, and then what we call the subsequent measurement. But focusing on the initial measurement, what does it mean? Now, when you talk about the initial measurement is basically portraying the understanding that if you should buy the asset today, if you buy the asset, let's say you go to the market, you buy the asset and you bring it to your premise today, and you want to recognize this asset in your books, what value should you just give this asset? Okay, so if you've gone to the market, you acquired something, what value should you give to the asset? And it's very simple. Now, we are saying that once an item of PP qualifies for recognition as an asset, it will initially be measured at cost. That is it. So you buy an asset, you've not used the asset yet, you've not done anything with the asset. You bought it, but you want to show it in your books. You should just record the cost of the asset, right? But this cost has some component. So we are going to look at the components that goes into the cost of this asset, okay? So when you talk about the cost basically includes purchase price. So when you talk about purchase price, when you go to the market, you want to buy an asset. Now this asset, let's say, costs 10,000, okay? But I realize that I've placed into brackets less any discount or rebate. So you went to the market, you bought an asset of 10,000, but then you asked for, or they give you a discount of, let's say, 2,000. So you realize that the actual price you paid for the asset is no longer 10,000. It's now 8,000. Is that not it? So that is a purchase. That's your purchase price. Now, duties and non-refundable taxes. There are instances where you import some goods. Now, let's say you imported the goods and then you are paying some duties on it, right? Now, these duties that you are paying on it, these taxes that you are paying on it, they are all directly associated with the asset. They are all part of the asset, the cost of the asset. So it means that you must add the duties and taxes to the what? The cost of their asset. Is that to the purchase price? Now, we also have what you call directly attributable costs. Now, when I say directly attributable costs, what are some of these things? Now, site preparation costs. There are some assets that when you are buying, until you prepare this site, until you actually incur some cost on preparing the site to suit the condition in which, you know, the assets can function, then we say that then it means that the assets cannot be mounted, or cannot be assembled, or cannot be installed. Is that not it? So all these things are directly attributable costs. You also have initial delivery and handling cost. So you bought an asset. Sometimes they have to, you know, deliver the assets to you, and then you have to pay a delivery fee. Now, this delivery fee is all directly attributable cost. After you buy the assets, you are supposed to mount, you know, the assets. Sometimes in mounting the assets, assembly costs or installation. Sometimes it requires expertise. You have to pay them. Now, in paying these people, these are all what you call directly attributable costs. So you have to add all these costs together. We also have what you call professional fees. So before you obtain the asset, you seek you went to consult the ideas of, you know, architects and engineers, whether these assets will be able to function at this premise, or whether, you know, you have to obtain this and all that. Now, these are professional fees. So when you incur such costs, they must be part of the cost of the asset at initial measurement, okay? And then when you talk about removal costs, there are certain assets that you are done using the asset, you must restore the land on which you were using the asset to its, you know, past condition, okay, or to its original state. What I mean is that there are some assets that when you buy them and then you install them, for the number of years that you install them, you realize that it destroys the land on which it was being installed. Is that not it? So there are certain obligations that, you know, these companies are, you know, tasked to do, that you are using this asset here. After you are done using it, you are obligated to restore the land to its original state. So we call it removal cost. So this removal cost, what is the definition? We say it's an initial estimate of unavoidable cost of dismantling and moving the asset and retaining the site on which it is located. I hope you get. So it's an estimate because you are using it for 5 years. So you have to make an estimate. You have to make a provision, right? So this estimate that you are making is in the future. So what it means is that after you make that estimate, you have to present value that future amount so that you can be able to add it to the cost of the asset. And I hope the explanation makes it very clear. Now, so that is for the initial measurement. Now, when you talk about subsequent measurement is when the asset has been in your books for, you know, one accounting period. Are you with me? So the asset has been in your books for one accounting period. Subsequently, how do you treat it? How do you measure it? What value? How do you show the value? I hope you are getting. So these subsequent measurements can be carried out in 2 approaches. Okay, so we say that 1, we use either the cost model or what you call the revaluation model. So the cost model basically has to do it. Initially, you recorded the cost. So at the initial measurement, you recorded the cost, right? And after you recorded the cost, these assets have been used for 1 whole year. So it could be that, it's not that it could be, it is certain. It has been used for 1 whole year. Depreciation could amount, is that not it? So you have to calculate the depreciation. There is the chance that these assets could also undergo impairment. So impairment will treat it more under IFRS 36, okay? But then this asset could be impaired. Now, all these things happening under the first year, you must subtract it. So you must subtract the impairment, you must subtract the depreciation from the actual cost that you recorded at initial recognition. And the value, which will be called the carrying amount, is what will show in your books in the second year. Are you with me? And then when you talk about revaluation, there are instances where we have we have a certain amount of assets in our books, but then you realize that when you compare it to the market price, they are not the same. So let's say you have an asset in your books for, let's say, 10,000, but then at the market value, the price of that asset as at the time you are looking at it is like, let's say, 15,000. You could really tell that you've understated the cost of the assets. Is that not it? So what happens is that we call what we know as a revaluation analyst, okay, an expert, to come and revalue the asset. So in revaluing the assets, it means that they are giving a new value to the asset. They are giving a new cost to the asset. So this revaluation or this cost they are giving is equivalent to the fair value as at the time of the revaluation. Okay, so the fair value is the same as the market value. So it means that you are changing initially, I mentioned 10,000 as a cost in their books, and then 15,000 as the actual price on the market. Is that not it? So what happens is that we are going to take the fair value of the asset. We are going to change the value of the asset from 10,000 to 15,000. Is that not it? Now, if there is any form of depreciation that we need to charge, we will charge it. If there is any form of subsequent, impairment loss, you will also, subtract it. So this is basically the subsequent measurement. This is basically a breakdown of the subsequent measurement. And you don't have to worry, because all these concepts, we are going to break it down and make it more practical in our, question solving tutorials, which will be a video that will follow right after this particular presentation. Okay. Now, this revaluation, it is not something that we do it every year. Okay. That revaluation could be done every 3 or 5 years. So after you have some, the value of an asset, let's say you are using an asset for 10 years. After every 3 years, you can, subject it to revaluation, invite experts to know, whether you really need to revalue the asset or not. So you could be doing this every 3 or 5 years. Okay. Now, when you talk about this revaluation model, which is the carrying amount, now we are saying that there are instances after you subject your PPEs to revaluation model, there is a way we account for it. So instances where your carrying amount is more or it increases, there's an increase in your carrying amount, or there could be a decrease in your carrying amount. Okay. So when there is an increase in your carrying amount, how do you subject it? So when you say an increase, you realize that for every debit entry, there must be a corresponding credit entry, right? Initially, the amount in your books was 10,000, but right now it is 15,000 in the market, and you've recorded this in your PP. It means that you've debited your asset by 5,000. Now that other leg, that credit entry, where should you go? So we are saying that you should credit it to your equity under the heading revaluation surplus. But instances where this asset has already been subjected to impairment, it means that there is a loss somewhere in the P&L. Is that not it? So you must credit this, you must make a credit into the income statement to reduce that loss. And then if there is a decrease means that you've credited your PPE by that amount, right? So the corresponding debit entry, where should it go? So we are saying that you must debit it directly to expense in profit and loss account as revaluation loss. But instances where there is already a credit, in your equity, under your equity, or there is already a credit in your revaluation surplus, then you just have to debit it to reduce the equity to that amount, by that amount. I'll be betting it. Now, when they talk about depreciation is basically the allocation of depreciable amounts over its useful life on systematic basis. So we are going to break this one all down. So you are using an asset. Anytime you are using an asset, that asset undergoes what you call wear and tear. I hope you are getting it. So you realize that the efficiency of the asset can never be the same. Let's say you are wearing a slippers. You realize that if you're wearing the slippers consistently for 1 year, it will not be in the same shape in the next year. Is that not it? Realize that it loses its value. It undergoes wear and tear. I hope you are getting it. There are certain gadgets that you are using. Realize that sometimes you use the assets. It was very, very fast, but subsequently you realize that it starts getting slower because it has, undergone a lot of activities. Is that not it? So that is what depreciation is there to do. Depreciation means that we are basically, trying to, look at the work rates that has been going on, and then we are spreading this amount of the depreciable amounts over the useful life. So useful life is how long do we think the assets can last, and then on systematic basis. So when you talk about the systematic basis has to do with which depreciation method are you applying. Are you using straight line? Are you using reducing balance method? Are you using sum of year digit method? All these things. So when you talk about depreciation amounts basically has to do with how much of the value of the asset should you subject to depreciation. So we are saying that it should be the cost minus residual value. So cost has to do with the original cost of the asset, right? Residual value has to do with if you should use the asset. Let's say you say that you can use the asset for 5 years. If you should use the asset for 5 years and you want to sell it out for scraps, how much are you going to sell it for? Is it 2,000? Is it 3,000? Now this 3,000 must be subtracted from the original cost before you subject that amount to depreciation. Okay. Now when you talk about the useful life could either be number of periods, that's time. Like I said, it could be used for 5 years. It could be used for 3 years. That's time. Okay, that is period. But there are instances where we can also depreciate an asset based on number of units of products. So if we buy an asset and we say, oh, this asset will help us, produce 50,000 units of this particular item, then it means that we have to depreciate it based on that, how we are getting it. So useful life can either be in time or it can be in units. Are we good? So when you talk about useful life, residual value method, we are saying that, all these things are, accounting policies that we can change every financial year. Okay. And if there is any change, it should be accounted for as an accounting estimate. IS8, prospectively with no statement. When you say prospectively with no statement, what they are saying is that if, let's say, you say you are changing your useful life, you are changing your depreciation rate, or you are changing your number of periods that you are depreciating your assets for, they are saying that you don't have to, go back and then restate the amount. You just have to, after you've changed it, you just have to go for it and then apply the change like nothing has happened. Are you me? Then we also have what we call derecognition of PP. So initially we spoke about recognition, right? So recognition has to do with at what point can you show this in your books. When you talk about derecognition is basically looking at what should happen for us to take this PP out of our books. So there are instances where certain conditions that could happen where we can take PP out from our books, right? So one, the assets could be disposed, or there could be that there's no future economic benefits expected to flow to the assets. So you realize that when we were doing the recognition, we said if there is the probability that a future economic benefit will flow to the entity associated with the asset will flow to the entity, then we have to recognize it. So the opposite is true. If we do not have the belief, or the probability of it having a future economic benefit flowing to us is very low, what it means is that we can just take it off, right? Or we can also dispose it. There are instances where when you feel like, okay, we don't need this asset again, we just have to sell it off. Disposal basically has to do with selling the assets off, right? It means that we can just take it off, right? Now, anytime an asset is being disposed, it brings about what we call gain or loss on disposal. So how do we get this gain or loss on disposal? They are saying that it should be your net disposal proceeds minus the carrying amount. So what is the net disposal proceeds? Net disposal proceeds has to do with you sold the asset for 15,000. That is the net disposal proceeds. So we record 15,000 here minus, but before you were selling it, the amount in your books was like, let's say 10,000. The value of the asset in your books was like 10,000. So right that you are getting a positive figure of 5,000. This is a gain. I hope you are getting this again. So it means that you've sold the asset and amounts higher than what was showing in your book. So it's a gain. If it's other way around, then it becomes a loss. And then in our subsequent videos, we are going to talk about all these things, how to break it down, how to do the treatment so that it becomes very, very practical. I hope you are good. Stay with us and then find the link below so that it will take you to the next video following this particular video on how to, get a practical question solvings and then get an understanding on how to resolve such cases. Okay, so this brings us to the end of our presentation.